Hi, and welcome back to the Food Fund, where we analyze investing in food stocks. If you love food and love buying food stocks, beverage stocks, and restaurant stocks, you will love this channel. In this video we will be analyzing if GEN Restaurant Group stock is a buy. GEN Restaurant Group, stock ticker symbol GENK, is just one of many companies we explore on this channel. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on GEN Restaurant Group. GEN Restaurant Group was founded in 2011, with headquarters in Cerritos, California. They focus on the fast casual dining experience, offering a cook-it-yourself twist on Korean barbecue. In addition to their amazing selection of marinated meats and sides for grilling right at your table, they also offer tasty delights such as katsu, a meat cutlet bowl, mandu, which are Korean dumplings, and japchae, a favorite stir-fried glass noodle dish. Going public just last year, the company embarked on a new stage in their journey by acquiring liquor permissions and selling soju, the famous Korean distilled alcohol. Today GEN Restaurant Group has over 35 locations and is looking to expand even more this year. Now let's look at the price action. Starting with the 1-year chart, we see that GEN Restaurant Group had a CAGR of about -58%. We also see that the company has been public for less than 1 year, and that year has been very tough for shareholders. GEN Restaurant Group share price has been in a steady decline over that time. Over the last 6 months, a comparison of investing in GEN Restaurant Group versus the S&P 500 shows some poor results for GEN Restaurant Group. In that comparison with the S&P 500, an investment in GEN Restaurant Group would have declined by 59% versus a 14% gain if invested in the S&P 500. Now let's hop over to market share and take a look at GEN Restaurant Group's market share. Here we have the dashboard, where we can quickly gather a lot of information at a glance. Expanding the dashboard, we can look under restaurants and see that GEN Restaurant Group is categorized under casual restaurants. Expanding the casual restaurants tab, we can see that GEN Restaurant Group has the smallest market share and is actually shrinking. Let's look closer at the year-by-year changes in market share. So we come down here and type in the ticker symbol for GEN Restaurant Group and see that the market share is just 0.01% out of the publicly traded food, beverage, and restaurant stocks currently in the market. GEN Restaurant Group is tiny and does not attract a lot of food spend. The 5-year market share CAGR for GEN Restaurant Group is -13.1%. This means that GEN Restaurant Group is essentially giving up market share to other competitors in the restaurant space. If we start in 2019, we see that the market share was 0.015%, 0.008% in 2020, 0.016% in 2021, 0.017% 2022, and 0.008% over the trailing 12 months. For such a small company, declining market share is really bad. Let's take a look at the fundamentals to learn more. Gross margin is 20%. This is on par with other similar restaurants. Revenue has compounded at around 12% over the past 5 years and has reached over $181 million most recently. Growth is clearly slowing, but trend continues. Looking at cash flow, we see a 17% CAGR over the last 5 years for operating cash flow, while capex has worsened at a 35% CAGR. As a result, free cash flow has actually declined at a 8% CAGR, with operating cash flow peaking in 2021. Capex has been steadily increasing as GEN Restaurant Group continues to try to grow their footprint. The good news is that free cash flow remains positive despite those two headwinds. Weighted average shares outstanding have risen since IPO, going from 4.1 million shares in mid-2023 to 4.2 million shares most recently. GEN Restaurant Group has been diluting shareholders. Of note, the share count may be off here, though the quarterly reports confirm that there are 4.2 million diluted shares outstanding, while CNBC shows 32.3 million shares outstanding. Now let's view return on invested capital. Return on invested capital has fallen from 16.1% in mid-2023 to 6.8% most recently. This is not ideal. Gen Restaurant Group has become less efficient in driving profits from its investments, though the data for the past 5 years is sparse. Hopefully, future earnings reports will include the metrics needed to calculate these values. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Unfortunately, the metric is not included because the metric days sales outstanding is missing. I'm not sure why that metric is not there, but we can see from the days payable outstanding and days inventory outstanding that Gen Restaurant Group is paying their suppliers earlier and holding onto inventory longer. Both the opposite of what we want to see. Now, let's look at Gen Restaurant Group's debt. The net debt to EBITDA has increased over the past 5 years, going from 0.7 in 2019 to 5.9 most recently. This is a very high debt level, especially after the company raised $43 million in their IPO in 2023. This could become a problem later. The fundamentals of Gen Restaurant Group are a bit disappointing. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Gen Restaurant Group. It is a restaurant company with a gross margin of 20%. The revenue per share CAGR is 9% and the free cash flow per share CAGR is -86%. While the revenue growth is acceptable and the gross margin is decent, falling free cash flow coupled with shareholder dilution results in a very bad free cash flow per share CAGR. A return on invested capital of 7% is low and trending downwards. Next, while the cash conversion cycle could not be calculated, the days payable outstanding and days inventory outstanding are trending in the wrong direction. Using the days sales outstanding value of 7 days from Kura Sushi as a comp, we can calculate an expected cash conversion cycle value of -12 days, which is not too bad. Regarding debt, a net debt to EBITDA of 5.9 means that it would take Gen Restaurant Group almost 6 years of earnings to pay back their debt. So from a fundamental standpoint, Gen Restaurant Group has some pretty big challenges. Now let's switch our attention over to valuation. Gen Restaurant Group is overvalued relative to the S&P 500 with a ratio of 2.8. The price to earnings growth, or PEG ratio, is unable to calculate it because not enough analysts cover the stock. While Gen Restaurant Group has had steady growth over the past 5 years, its market share has actually been in decline. This is a very important distinction that we need to keep in mind as investors. Growing revenue is not enough. Companies need to at least grow revenue in line with the industry, but ideally be outpacing the growth rate of their industry. Especially in the hyper-competitive world of restaurants, market share growth is essential. Beyond that, the company has rising operational costs and declining free cash flow. However, Gen Restaurant Group is not in danger of going out of business because they are self-sustainable and do not require additional cash injections to run the business. The biggest existential risk the company has is their high debt load. I hope management seeks to aggressively pay this down while free cash flow persists. Gen Restaurant Group is a wonderful concept and I hope they do succeed. However, as an investor, I find too many investing metrics to be lacking. For me, Gen Restaurant Group is not going on the watch list. Many thanks for watching. What do you think about Gen Restaurant Group and their high debt load? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.